All right, we are live. How are you doing today, Chris?
Doing good, Tusif. How are you today?
I'm doing wonderful. Apologies for the some hiccups, unfortunately. Uh, there was some technical issues, unfortunately, that we had to drop. Uh, but no worries. That's just part of the way. That's part of the life, and we will be coming back. So I know we left off yesterday on a lot, not yesterday, on last Wednesday, regarding one of the very important topics on 1031 exchange. We're going to be talking about that and some new other topics. But before that, I want to ask Chris about a very important situation that IRS just has announced about e-file. Chris,
Yeah,
fill us in.
Tusif, it actually kind of caught me by surprise. It was either earlier this week or late last week that I subscribed to the IRS newsletters and technical alerts, and lo and behold, boom, popped out that said, guess what? Saturday, November 18th at midnight, we are cutting off electronic filing, which means that if you have not filed a return or have other returns to be filed, they're going to have to be mailed. So if you're looking at this live, know that you got about 3 hours to get that return electronically filed. If not, you're going to have to mail those in, or your clients are going to have to mail those in and sign them, put them in the mail, make sure they're sent certified mail so you have evidence that it has been filed. So that if the IRS says anything, you can plop down that little green card and say, no, it's filed. Here's the signature on it. So therefore, you can take away these late fees. So,
Absolutely.
yep.
I know I was listening to another preparers podcast where one of the reasons that they were getting a late fee is because IRS claimed that they got it late more towards the next month,
Yep.
especially if it is 18th. We're almost towards the end of the month. So if it passes November, you're going to be charged additional 450
Yep.
or the amount of taxes owed, whichever is lower. But coming to the aspect of where we left off last week, I know we were talking about 1031 exchanges and the capital gains associated with it. We did understood the aspect that the capital gains goes away because the base of the new properties, if it is inherited, becomes the fair market value of the property at the time of death. But what happens in case of depreciation recapture if the parents actually have been taking the depreciation as well?
Well, here's some good news that depreciation capture went the way of the capital gains. As soon as your person who passed away, Aunt Ethel, or your parents, what have you, they passed away and they passed this land on to you or passed this property on to you, guess what? Your the capital gains went away, depreciation recapture went away as well. So you're starting off fresh. Now, sometimes you may have something, a discussion with a relative, and they want to give you the property now because they think that you'll benefit from them. Then you need to stop them and say, no, don't do that because it's going to be a huge capital gains for me. So say that Tusif and I live here in Northern Virginia, and someone bought a house back in, Aunt Ethel brought one back in 1971 for about $5,000. Well,
Wow.
now we have $1 million houses. So the capital gains would be $995,000. And you pay what 37% of that is going to be going to taxes. Or you could tell Ethel that, hold on a second, well, let's wait till you pass and then send this to me so I don't have to pay all the capital gains tax and I can have more cash in my pocket, which the good lady wanted you to have. So just make sure that you communicate. And that's why we always talk about, okay, communicate with your CPA, communicate with your loved ones about what your intentions are so that you know what's going on.
Absolutely. And as a matter of fact, uh, the concept of passing away brings us to the element of inheritance tax as well, and
Yep.
also gift tax. Fill us in a little bit about that part. What
Well,
happens then if someone were to gift or if we were to inherit? What's the difference?
so what's going to happen? The main thing when since we're talking about property, is going to be the capital gains on the property. There are several states that tax inheritances, and I know Pennsylvania is one of them. Virginia does not. So you don't have to. Citizens of Virginia, you don't need to worry about it. But before you're thinking about that and making the will, what have you, check with your CPA and your attorney in your state to see what are the rules, what are the taxes on these before you make a move and you make that will. So that, because really, when people are making a will, you see all these movies about people dying and they're writing. Father Mulcahy is writing the will on his notepad, what have you. But most of the time, there's going to be time to go through and say, this is what I want to do. I would encourage everyone. There's a great product called the Family Love Letter that will help walk you through everything that you want to do and where everything is, so that you just hand this over, or your kids will have access to it, so they know exactly where everything is and what your wishes are, so that they don't have anything to worry about. But as far as inheritance taxes and capital gains, as long as you've sent the property over when you pass, there's not going to be any capital gains at that point. It's just going to be if you decide to hold it and sell it down the road.
Awesome. Is what happens to the gift tax on the person who actually is gifting to somebody, or say, for example, parents give it to the children or grandparents give it to their grandchildren? What is the aspect of the gift side, if there is any? How does that work out?
Well, if we're talking about, there's a certain dollar amount, and the last amount I saw was $17,000 a year that you can give someone. You don't have to fill out a gift tax return. But if it's more than that, you do have to file a return, and there's not necessarily going to be taxes you're going to owe on this, but it's going to be used later when you're filling out when your state return is being filed, and you have a certain amount of gifts that you can give in your life, and it's going to be chipped away there. But there's some. But if you're thinking about giving gifts to someone, say that your child has a spouse, and you want to give them a certain amount of money, well, you'd think, okay, $17,000, what I can give my son. Well, hold on a second. Maybe you give $17,000 to your son, $17,000 to your daughter-in-law, and your wife could give $17,000 to your son and $17,000 to your daughter-in-law. So that's what's that going to be? It's $68,000 that can pass from you down to them because you were smart about this.
Absolutely. That's a great point you brought up. Is, of course, let me ask you this first. Who pays the gift tax? The one who gives, or the one who receives?
The one who gives.
Awesome. So if you are thinking that, hey, I want to pass these to my children or grandchildren, remember the aspect of you have a certain dollar amount on a lifetime value. On lifetime, it changes, inflation adjusted. Last year it was 12.6 million. I think this year is going to be 12.9, but it's gonna vary. But the fact Chris was talking about is each year you can have that amount of tax, that amount of money given out to whoever you want, and it's going to be for each individual. 17,000. It's 16 and some change. Let's make it easy. 17,000. Most likely it's going to be 17,000 this year. And each individual that you choose can get it. But here's the caveat. You can do that, but if your children are alive, and if you're gifting to your grandchildren, there is something else that's going to trigger GST, general skipping tax. So make sure always stay below that limit, so that gift tax does not trigger, and on top of it, that GST tax does not trigger, because it's, I think, if I remember correctly, it's 50% or 60%. That crazy amount. But if they're not alive, then you can actually do whatever you want, because that's not skipping a generation. It's pretty much having the same heirs to give it. So that's really a very broad aspect of inheritance that we just brought up. And I want to include a couple of elements here. Is the process of this transfer of property. If no document is set up, it goes through the probate. I would love to hear from you, Chris. Do you happen to know anything in terms of taxation in the probate process?
Well, I haven't really dealt with that, but that's going to be something that you, again, why TUSIF is saying that you want to have something written down, my five rules, document, so that you don't have to go through that. And it's a much more involved process that you're going to be putting your heirs through. So make sure that this is and people ask me, what's the bad thing that's going to happen? Well, don't try to do the bad thing. Just
Yes.
sit down and get your will set up, and so that you don't have to go through probate, because you don't want to do that to your kids, or maybe you do and you're just a bad person. I don't know, but really don't do that. I don't want to put my kids through that. I know my parents don't want to put me and my brother and sister through that as well. So make sure you have everything ironed out. So and
Absolutely.
so don't
And as
let's not focus on, well, what happens if this happens. No, just don't.
so that's, folks, that's how bad it becomes, to be honest. Being a real estate investor, I have come into these probate situations. If you are into distressed properties, one of the main sources of distressed property you will see is probate. One of the ones that I was working through in is also in Manassas. It's a 950 value property that sold for 720. Think about the difference of that, because they didn't have anything in place.
Mm-hmm.
So don't get yourself into a bad situation and don't wait up until that. If you have something, it's always best. I mean, the worst thing is you do nothing. A better thing is you have a will. Now, depending on states, some states are more favorable to wills than others because will is a public document.
Mm-hmm.
It goes through the court, but your heirs still have to go through the process of the court with fees, being present, and all those kind of stuff. If your children are in other states, it's going to be significantly difficult. But when you become a trust, the trust, even the simplest form of trust, even if we don't think of the more complex ones that gives more tax benefits, even the simplest ones gives you the authority and the ease of transferability, because that's the fundamental purpose of trust. Now, when you are setting up a trust, make sure to talk to us or your CPA, wherever you are, so that you understand what the functionality of that trust is. And whenever that becomes, trusts also needs to file taxes. So if you have a trust set up, even if you don't have to pay taxes, even if that's used for tax deferred purposes, make sure you have to file those taxes. So that's one thing I wanted to talk about, the inheritance part, because the disposition of 1031 exchange always comes down to that. And I know it might be for some people very heartbreaking situation, of course, loss of family members. But even with that, for some people, it might just be bringing in a huge opportunity as well. Especially if they do things right, you might be getting a significant amount of estates, which might be tax-free, as Chris was mentioning, from 1031 exchange. You're out of capital gains and you're out of depreciation recapture as well. So just make sure if someone's trying to give the properties to you, they say that, hey, let's put it on a trust, or let's wait up until there's, I'm always yours, I love you, I'm always with you. So that's a great opportunity for us. Now, when it comes down to this 1031 exchange, especially when it becomes big, a lot of people comes down to the multifamily in two ways. One is syndication and another is JV, which is partnering up. So let's touch base on the point of syndication, Chris. What do you think about syndication, and what should someone consider at the beginning if someone is setting up a syndication from a tax perspective?
Well, keep in mind that with a syndication that you're going to have to just lost myself here. Well, with syndication is that the money that's going to be passing to you is going to be taxable. So you have a syndicate set up. It's almost like a partnership, basically. So you're going to be paying money on the income you receive from it, and then you're going to have deductions that are going to be passed through to you. and those are going to be deductions, as well as if the syndicate sells property, then you're going to have some capital gains on it. And I kind of think of this as this year our local football team got sold, and there's one person who bought it, and then the devil who got brought from, we won't mention his name, but everyone sees the one person in charge. Well, that person may only have like a 2% share, and they spread it around a bunch of different people, and just the one person who owns the majority of the controlling interest is the one you hear about. So, but with a syndicate, that you are going to have these different partners in with you, and the syndicate itself will pass the income and expenses down through you, and you'll be taxed at your income level through that.
Absolutely.
Joseph?
Yep. So let's bring up some basic ones. What I was thinking about, maybe draw this one up in a whiteboard. Let me know if I can share my screen real quick.
Sure.
Okay, so here is our syndication. I'm gonna have some presentation for people. So this individual, for syndication purpose, as Chris was saying, has two boxes in it. One is called the GP, which is the general partner, and the other one is called an LP, which is a limited partner. Now, GP is going to be the one who are going to be actively participating in the entire thing. So this is the syndication. Let me have it caps. Then we have something as GP, and we have something as LP, which is called limited partners. Yep. Now, syndication, if there's a property in here, what it does is it works as a partnership, but the difference with a regular partnership is the authority of GP and LP is different. So the LP, limited partners, come in with only money.
Yep.
All they do is participate in money. And if you have followed our previous episode, we spoke about at-risk rule. What it means is LPs are only limited to how much their risk is in this deal. But they don't make the decisions of the deal. So if there was a lawsuit or anything that goes south, the LPs cannot be personally liable for this. So that gives you a personal liability protection if you're considering investing into syndications. On the other hand, if you're a GP, you control the deal, but if anything goes south, you're responsible. Now, with
but keep in mind, folks, the limited partners, there's only so much they can make in a syndicate. They have, you will get this much of the profits, but a general partner is going to, the kind of sky's the limit on this. They're not limited. So I'm sorry, Susan, go on.
No, that's a great point you brought up. Is GP syndication structure with GPLP allows you to consider the risk and also consider the associated elements as well. Now, in terms of tax purposes, one thing I wanted to also come out is each of these GP and LP might be even persons, depending on how you structure it, and might even be a corporation or individual or LLC as well. So now, when it comes down to taxation purpose, make sure that what happens on the depreciation. For GP, it is an active income, active business. They are going to have self-employment taxes. But all of if they take a bonus depreciation, if they do cost segregation, whatever, what forth, we talked about them last week, and we're going to be talking about that in the future state as well. They can take all of those against them. In most of the cases, GPs are going to be being qualified as a real estate professional. We're going to talk about that in a few, if not today, next episode. But the LPs, unless they're qualified in something else, they're not going to be able to take the full loss here. This is an interesting situation in terms of taxes. This guy gets active tax treatment, but this guy gets passive tax treatment. What it means is, for him, this is a passive income. For him, this is an active income.
Right. And so what's going to happen, though, folks, is think about this. If you have losses, there's only a certain amount of losses that you can take, because you have to have passive income to use it against. So you may have, and I've run into this quite a bit, is they have a passive loss on something. Well, I had this huge passive loss. Why couldn't I take anymore? Well, you didn't have any passive income to use this against, even though you may have a big salary, you had a company that you're running, but you were counting on the losses from here to offset it. Well, it doesn't work like that.
Awesome. So let me ask you this, is, say, for example, someone owns a business and he sold his business. That's pretty much a capital gains in most cases.
Yep.
Now he took that money into syndication.
Yep.
How much, or if he can use that passive loss against his capital gains?
Well, just because, okay, so he sold the business, and that's going to be capital gains. You are right on there. But because he was more active, because the business was something active that he had, that's not passive income.
Awesome.
So we can't, yeah, it's unfortunately, sorry, this doesn't work, but you'll have passive losses that can be carried forward, and you'll be able to use when you basically hit the jackpot and you have big income.
Absolutely. That's one thing for the viewers to always consider, is when you are considering investing into syndications from a tax perspective, it is great to have that passive income and passive losses. But unless you have passive businesses can also be passive.
Yep.
If you have passive businesses and if you have those coming in, you can use that passive loss from your syndication. But if you have an active business, or if you have a capital gains, you just cannot write it off. The max you can do is $3,000 if your income is more than 150 grand. And if it is below 100 grand, you own more than 10% of the property, which is you're more than 10% of the LP shares, then you can potentially get up to 25,000.
Yes.
So these are the two exceptions. But if you're in a GP who may qualify for rep status, then yes, all of those syndication property losses are going to be for you as active income. But make sure, in this case, you are going to be paying Social Security and Medicare taxes, that 15.2%, unless you keep rolling into that 1031 exchange we talked about earlier. And the good part is, if you make enough losses, you can essentially take your money to zero. Then 15.2% of zero is zero. So that's how I have a couple of friends who does run syndications. I recommend investing in them, but of course, when you are, make sure you have similar type of business, because I want to share this thing with you guys. Make sure to always keep this in mind. Active income takes on active losses. Passive income takes on passive losses. If you don't take it, then it's not going to work out. Capital gains is going to be taken against capital loss. So what happens if you end up in a situation where the syndication sold the property, depending on, again, how this is structured? If there is a capital gains or capital loss, you may be able to take it against other capital gains or capital losses. That's why that income type becomes significantly important. That's why I know I sometimes mess with Chris's brain. That's why I asked this question, for being such a dumb on my end, is what happens if I sell a business. Now, if that's a capital gains, you can take it against capital loss. But just because you lost money in something, or if you have losses, you just cannot go ahead and take it. So
right. This is all part of a conversation you need to have with your CPA and your legal and partners, what have you. But what I always advise people against is don't do something for the tax effect, but know the tax effect of what you're doing.
absolutely, that's a great thing. That's today's code.
Exactly. So the thing about it is that I always get my business owners, they call me up, so hey, should I buy a Tesla so I can have something to write off? And my question back to them is like, okay, great. How's that going to bring in more money? Because people, when they go into business, they want to be millionaires, have $1 million a year coming in. Well, okay, but if you're so concerned about these write-offs you're going to have, focus more on bringing in more cash so that you're not as worried about taxes. And the more complicated you get, you've got Tusif and I to help you make sure that you don't pay too much in taxes. But focus on the gains that you could have and the business that you can build.
Absolutely. And folks, as Chris always mentions, there's no such thing as a dumb question. If you need to know anything and you feel like it's going to sound dumb in front of Chris just because he has a lot of experience, don't worry about it. I personally asked so many dumb questions. I felt embarrassed, then I realized that, and I'm at a point that I agree with Chris that there is no such thing as a dumb question.
Absolutely.
So I end up in a situation that if this is a question and a concern and it's a real life problem, I'm definitely asking that.
Absolutely.
All right. So now let's talk about, I know we had a lot of great things covered in the syndication passive losses. Now, what happens instead of having to be a partner? So in this LP, what essentially people do is put their money for equity. I know my handwriting with mouse is not the best, but that's okay.
We won't show this to your kids when you get after them about their handwriting, all right?
I mean, my parents wanted me to become a doctor, but
well, I think you're well on your way looking at that.
That's when my sister became one. I was like, hey, I cannot take, I mean, I have respect for medical people, but I was not someone who would be able to sit down and go with 80 years of study.
Yeah.
That's why I ended up studying with this creative stuff. But coming to the point is, these partnerships are giving money in exchange for equity. But what happens if it becomes a lending income?
Right. So anytime you're going to be lending, you're going to be, you should be, okay, should be. Do not give money to somebody and not get something in return. You are going to be receiving interest for it. And at the very least, the, sorry, folks, it's after 9 o'clock on a Saturday. Imputed interest. Right, exactly. So you're going to have interest. So you will be earning money on that. And the person that you've lended money to will be able to write that off. So that's something that you'll be able to, that you're going to have to claim as income if you're lending, but also write off if you are the lendee.
What kind of income is it going to be? Passive, active, or capital?
It's going to be, that's going to be ordinary income. That's going to be active.
So is it going to be active for ordinary purpose, or is it going to be passive for ordinary purpose? Because I'm not doing anything with it.
I'm pretty sure it's going to be active income.
Awesome. So say, for example, someone from GP, instead of having this, again, in my mind, I was thinking that it might be passive income just because from the lendee perspective, So from the lender perspective, because they're not actually doing anything. But again, we can double check and come back. But for our purposes, we both agree on the aspect that what the tax implication is going to be, whether it's active or passive. In both cases, you are going to be taxed as an ordinary income.
Yes.
It is going to be a ordinary taxable interest. So what happens is, say for example, this GP in the syndication or any other deal, I'm gonna now turn it into any deal, because typically syndication's purpose is to get into some sort of deal or some sort of fund that is going to be eventually in real estate, going to be investing into some sort of deal. All right. So if this GP goes into some other private lenders to cover the initial cost that may be required for the down payment, then if that guy comes in and say, for example, this is $1 million house, $1 million property that they're going to be buying, they need to come down with 200 grand. Okay. So for this GP, some part of that is supplied from that LP of that 20%, say for example, 20-25%. So the GP needs to raise about, just for the current market rate, be realistic, needs to raise 25%. And the LP comes up with a total of 15% for the sake of our example. The remaining 10% needs to be raised by GP. Now, GP becomes really creative. He goes out and says that, hey, instead of me paying that from my end, I raise that money of 15%. Now, the 75% of this deal is financed by the bank or the lending institutions. But that 15% is now being fed from private money lenders. For them, this is not, they're not becoming an LP unless they come up with a certain big agreements. These private money lenders are going to get something in return called note. And we're going to be going into the notes as well, because note itself is a separate business. I'm going to talk about notes and their tax implications in details as well. But coming to this aspect is this private money having this, they're going to get a note, and that note is going to have some interest. Now, unless it's your very close friend, you're doing it yourself, and you're just moving money from your C Corp to your LLC, it's not going to be tax, from a tax perspective, it's not going to be beneficial for you to go 0%, because IRS is going to come at you, as Chris mentioned, with imputed interest.
Yes, indeed, they are.
So that means it is that this imputed interest is pretty much what is based upon the average interest rate for market. So the current rate in some cases, as you have a lot of real estate investors have been hearing that, hey, the rates raised. It used to be 1%, 2%, and now it's 5%. But when you go to get to that mortgage, it becomes 7-8%. If you're taking personal loan, it becomes 8, 9, 10% if you're taking commercial loans, which is going to be most of the cases of syndication deals. If you charge anything below that, IRS is going to say that it's going to be capped at that.
They will come back to you and say,
yes,
no, this is what the income is. Even though you didn't receive a penny of it, they're going to tax you on money that you never received.
So whenever you're doing this, make sure to consider this note document real good. Okay, now instead of that, say for example, there's a differential of interest of, say for example, 2%, 3%. Okay, so what this GP did is essentially getting a note for this 15% and taking that as depending on how they structure it, In some cases, they may have it as a second position lien against the property if it's a smaller deal. In a bigger deal, in some cases, they don't. They just have it against their own company. So it depends on different structures. But for the time being, this income, the interest that is going to be paying here, is going to be taxed as ordinary income.
Exactly.
Awesome. So to summarize the entire aspect, I know we talked about some very high hitting topics today. I'm going to go slow now so that people can consume these and understand. This structure here can be true for not only syndication deals, but also any PMP deals, private money partner deals. If the private money comes to this LP position, the dimension changes. That equity cash flow becomes passive, but this interest cash flow becomes ordinary. Now, we're going to be coming to the aspect of, yes, is it passive income or active income? But coming to the aspect of, if we consider this, how much, again, another interesting issue is, if your only income is based on lending money, like you become a hard money lender, that becomes your active business. Then your passive losses cannot touch your active income.
Yes, indeed.
But if you're not qualifying for that your main purpose, main existence is main income source is not interest income. You're just lending your friend and getting some interest back. Of course, we can double check. In my mind, it's still passive income. But in that case, we are going to confirm that. And of course, viewers, you guys, I would recommend check out and maybe comment on us as well, because we're talking about a very serious and interesting topic. If that interest is a passive interest, then you can take this one. But if you're a lender with active lending business, you cannot take it even if you are an LP. Chris, what do you think?
I think you've covered just about everything there, Yusuf. So
Awesome.
just yeah, there's a lot here, but we're just trying to give you an overview here. That's why it's important to have a relationship with a CPA to ask these questions and then walk through. And sometimes your CPA may say, okay, walk me through this again a little slowly, just to make sure that we're covering it, because there's going to be things here that you may need to talk to an attorney about and a CPA about. So you want to have a team together here when you're looking at these deals, and take your time with it. Don't be rushed into these, and make sure you got all your bases covered.
Awesome. Absolutely. So to summarize what we've spoken about so far. Today we spoke about 1031 exchange, where we are going to be we said that let me make this one as black. The first one, it looks better here. Oops. Come on, text. Okay. The first one we spoke about is 1031 exchange, where, oops, no, I didn't want this. Oh, wow. This has so many things.
I joke with the joke when my kids we were getting ready to have kids, that we had kids so they could program our VCR for us. So probably, Yusuf and I just need to bring in a 13-year-old who can help us.
Absolutely. Trust me, I'm looking for someone who can take these in the back end. I'm looking to buy those pens. Even though my handwriting is not the best, I feel like it's going to be a better and faster job. So we spoke about, and on death, capital gains, and no depreciation. No recapture.
Yep.
Second, we spoke about inheritance, where we spoke about the element of gift tax, how you can leverage, how you can stay below that, GST, which is generation skipping tax, what you should do and what might be you might be considering, your probate process, your will process, and your trust process. So on trust, the element, what it becomes is depending on where you are, some trust is going to allow you to defer it, some trust is not going to allow you to defer it. That's going to be depending on the trust itself. The third one is the syndication, where we spoke about GPLP structure, each individual's taxes, and what happens in case of private money lending. All right, so this is today's summary. If you guys have any questions related to these, or you want us to expand on any of those, of course, some of them we will be expanding. I would love to expand on the lending side and also no transaction side. We will be coming back with you on the aspect of active versus passive in much depth. But as I mentioned, as much as on my brain, if it does not betray me at the point, is if your business is lending, you're in the business of lending, it is an active income. But in both cases, you are going to be taxed as an ordinary income. But what you can take losses against is going to depend on where it is. Any last thoughts on what we have spoken about so far, Chris?
Well, as usual, Tusif, I'm going to go back to my top 5. Document, 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 document. Make sure that everything's documented. And when you are going into some of these deals that you're thinking about, make sure that you have your own attorney and your own CPA looking at it. You may have a guy that you're best friends with, but that best friend, things can happen to best friends. Make sure that your interest and your family's interest are taken care of, and make sure you have somebody that is speaking for you and not for the person who's putting together this deal.
Absolutely.
So that's going to be my big thing that I'm going to put here. And just take your time with this and always ask questions before jumping into something.
Absolutely. And to summarize the element, that don't do something just for the taxes, but do so much that the taxes becomes irrelevant.
Exactly.
Anything else? Any last thoughts with that? Otherwise, we can just call it a day today for now.
I think we've done quite a bit here, and we don't want to overwhelm people. So let's let this sit, and then we'll come back with more. And folks, if you got something and you want us to talk about it, please put it in the comments. Let us know, and we'll happy to get on there. And we enjoy these little chats here to talk about all this stuff. Tusif and I geek out over this stuff and try and put it to what I call normal people talk. So please let us know what other topics you'd like us to talk about.
Awesome. With that, I really appreciate your time, Chris, and the Saturday night, and everyone who is watching and everyone who will be watching. I appreciate everyone's time. Thank you very much. Our next episode, we are still going to be on the real estate topic. We are going to be talking more into those nitty-gritties and more functionalities, more creative structures, and also how we can potentially cascade elements in different ways so that we can essentially get the best of the benefits. With that, thank you very much again. Have a wonderful rest of the day, or rest of the night.
Good evening, folks, and have a good one. We'll see you on Wednesday.